Well, good morning all. Welcome to our brave new world with COVID and all of the challenges that we have. Thankfully, we're doing this as a webinar so we can survive the lockdown. So, good morning. My name is Russell Postle, for those who haven't met, and part of our not-for-profit team here at BDO. So today we're going to focus on the portable long service leave scheme, which strangely enough, of course, today is the end of the first quarter for which this scheme will be applying. So we're going to run through several aspects relating to it today. Just going to go through what it is in the context of the Queensland scheme, the key aspects, the fact that it's the portable long service for the community services sector, just what is that? The concept of employers and employees for the scheme, identifying the worker who is in, how we calculate the levy, how the long service leave will be calculated, and that's very relevant for the employers, the joys of the accounting and tax aspects. Of course, this scheme introduces a whole brave new world of the self-employed being an employer and employee of themselves, and then we'll just share some of the commercial risks that are applicable. Now, just so that everyone, when you're looking at the slides, LSL for long service leave and portable long service leave referring to the scheme here in Queensland, so that we can use the consistent term. So traditional long service leave is provided under the various industrial legislations, and an individual employee works for a single employer or related party entities. And after a period of 15 years, they're entitled to paid long service leave of 13 weeks. The traditional pro rata entitlement was after 10 years of service. So portable long service leave is where, instead of it being a single employer, an industry or a sector replaces that single employer. We've seen it for a long time in Queensland with the building and construction industry, with more recently the cleaning industries, and at the national level on some of the mining industries. So the employers contribute via levy, and the employee then claims their long service leave from the scheme manager. Ideally, the employer then has no liability to pay long service leave for those employees covered by the scheme, but that is not how this scheme will work. It is different here. So it will apply to where the employer retains their liability. So for the Queensland scheme, the entitlement to paid long service leave remains at 13 weeks after 15 years of service, but the pro rata entitlement comes back from 10 years to being 7 years service. It's important to note that the community service portable long service leave entitlements are prospective. That is, only time from 1 January this year will count for this scheme. So the first claim by a worker from the scheme will be when they first reach the 7-year mark to claim, which is January 2028. But however, employers can access and get reimbursements before then. So, and we will talk through that during the presentation today. It's important to note that the existing long service leave entitlements remain a liability of the employer. So they don't go away. And that's something that will stay there. So you'll have long service leave for those entitlements and accrued time, and it may well be that you've got someone who at 1 January 21 doesn't yet have any actual entitlement to go and claim. They haven't reached the 10-year mark, but they will do during the life of the 7-year wait under this scheme, and we'll cover off on how to deal with that. So the key aspects of the scheme for Queensland, and remember that this is a state-based scheme where the rail gauge debate is alive and well. Every state does it a bit different. So commencement date is the 1st of January 2021. The levy is collected by way of a quarterly return, and that return has to include the days to be credited for service and the payroll of ordinary wages. And we'll come back and talk a little bit more about that. So the first levy period is from the 1st of January to 31 March this year, so today, and the first return is due by 14 April 21. Now, that's to lodge and pay. QLEVY are the administrators of it, and they also, of course, manage the administration of the building construction and the cleaning industries, portable long service leave schemes, and they've recognised that there's a lot of learning happening at the moment, and everyone's trying to find their way through the minutiae of detail to make this work, including their own office struggling to sort of resolve some of the questions that are jumping up. So it is recognised that that there will be some delays as people learn and catch up on how to apply the scheme. One of the big distinctions from both the building construction industry and the cleaning is that the employees are not limited to those on the tools. So it's a far broader definition. So we will talk a bit about that in a moment. And so just keep that in the back of the mind, that it's always more than just that. So what is the community services sector? Well, we look at the Act, and of course it just says that it's the sector that provides services to the community, which didn't feel as though we gained a lot of ground on that. So in the explanatory notes that were introduced when the bill was introduced to Parliament, it has this reference to the community services, those that are providing support and assistance to facilitate community participation, enable independence, and protect and provide accommodation and respite for vulnerable populations and those in crises. Trust you feel that you got that worked out, just what is the community services sector. So it is still pretty hard to work out, because a lot of people will say, yes, I'm in the community services sector, but they may or may not fall within the definition in the Act. And there'll be many of those who would say, no, I'm not, but will be clawed back into it by the lists. So again, an open mind is needed. So let's start off with those who are excluded. Well, aged care is specifically excluded, so is childcare. Education providers, such as kindergartens, that's an example where they'll say, well, we're in the community, we're a community kindergarten, but they are excluded from it. General health care, so the GPs and most health services are excluded, and all government employers. So that they by definition, they're all excluded from the definition. We now have the joy of the Schedule 1 list, and this is the list of, which is Schedule 1 to the Act, and it picks up what are the key areas that are considered to be part of community services. So we've got a number of organisations that will fit clearly within some of those, and others that might fit in 2 or 3 categories. It is still fairly challenging to try and find where some of the boundaries sit. Things like employment services, what are disability support services? When you're supporting someone, is just where does that stop and start for community, for that disability support? And of course, for many organisations, the home and community care services will provide some challenge, because quite often they're delivered by entities that are also providers of residential aged care, and staff working across between the 2 categories. So that will be one of the challenges, and it'll come up under some of the commercial risks discussions, because the aged care work is outside the boundaries, and the home care work is within. So when we look down the list, it's important to understand what those lists are, and to refer back to these to say, where do I fit for some of those services that as an organisation we provide. Remember, of course, also that it's far broader than just not-for-profits. So we've got to understand what fits within some of the advocacy services, bearing in mind that many charities prefer to steer clear of being referred to as providing advocacy under the ACNC rules. So it's a key of understanding just where it all fits within that. So think about your own organisation and where you fit on that list, and whether you meet some of those. So if you only provide residential aged care, then it will sit outside it by definition. If only a GP, outside. But once you start getting into some of the broader areas of the mental health, for example, it's in there. One of the roles I have is with the RFDS on the board, and that one we provide mental health programs, and so we'll have some staff that will be in the scheme, and the majority who won't, because otherwise we're a general health provider. So it's going to be challenging to have to pick and choose which staff, and then the implications for HR management and how we manage some of those people going forward. So the employers, there's 4 categories of employer under the legislation. An entity established with the purposes of community services, where it engages an individual. In other words, it engages an employee. This whole new world, brave new world of the self-employed individual who provides community services, so they become an employer and an employee. A provider of labour hire services. So where they're providing that. Now my asterisk seems to have fallen off the bottom there, sorry. The asterisk is that the labour hire services are those entities that are caught within the corresponding Queensland legislation as a labour hire provider. So, so presumably it means that related entities that are controlled within the same group that are exempted from the labour hire rules are not within that. But it's a question whether they're still providing community services individuals. So the entity prescribed, so if you've got that situation, it would be something that you need to undertake further detailed analysis. And then there's the catch-all on both categories, employer and employee, of just someone that may be added by regulation. But as it said, all Commonwealth, state and local government organisations and entities that they control are excluded from this definition of employer. So they sit totally outside the whole scheme, do not come near it at all. Employees, in the Act, they're referred to as a worker, and it's an individual who's engaged by an employer to perform community services work. So in the labour hire situation, the labour hire company, the employer there will be the entity responsible to register and pay the levy, and then the employer would be for any of state employees, and the self-employed is in there as a worker as well. So it picks up all of those full-time, part-time and casual staff, so across all categories of employment. Okay, so one of the One of the interesting aspects of the community services sector is the extended definition of those that will be categorised as a worker. So it's not just those who are, quote, on the tools, actually out there delivering. Take mental health services. It won't be just those who are there meeting and delivering some of those services. It will also include the person in the office who's doing the scheduling. And then it comes back to the question of whether or not we're at boundaries. And we'll look through a few further examples of that. For a small organisation where only the services are delivered, it will be a lot easier question. But in the larger organisations, finding that boundary of where does it stop and start for those who are supporting the provision of community services will be a bigger question. So it certainly defines in the section the extension to include those who support the delivery, and this is quite different to others. Supervisors in the office are not included for the building and construction. It's only on the tools, and again, it's only those on the vacuum that get in the cleaning. So it's a real quite a distinct difference. So one of the things is to look at is who does the community services sector apply to? And if you feel as though you're in the sector, then you need to consider this question very closely. The key is to establish is if you are in the community services sector and which staff that you are there. So you need to go back to that list that was there. If you go and ask QLEVE, they'll suggest that you ask your staff what their expectations are. Do they think they're in the sector? But realistically, as an organisation, the organisation needs to make that clear decision as to whether or not it's in the sector. After all, it's the organisation that is required to fund this and to incur the additional costs that will go with both administering and funding the portable long service leave levy requirements. So the good part is that the self-employed, they need to opt in to be included. It's not needing to opt out, but rather they need to opt in. And again, we'll talk a bit further about them later on. So one of the steps then is to identifying the staff to include in it. So the example here, if all workers are engaged to perform community services, then they're required to be declared in the employer's return and the levy paid. Then all other workers engaged by that same employer, where that work supports the delivery of those services, the administration employees would also be incurred. Now, QLEVE's advice is that if you have that the after-hours cleaners don't perform or support the delivery of community services. Interesting question. So so that would mean that for a smaller entity, everyone right up to the CEO and the CFO, company secretary, etc., will all be within as support personnel and in the scheme. Where you have separate and distinct service streams that do not then they're not classed as part of a community service. You know, the example of someone who has an aged care facility and a home care functionality that they deliver the two services alongside each other, that will be this will be the category that you've got to look at. So you look at with all the staff that perform community services work only are to be required to be declared. And then for those staff who are mixed, you'll have to do pro rata on them. And then employees engaged to support the provision of this only to the extent that they are totally there to provide the support for the community services work. So then the rest of the employees are excluded from the calculation. It's not saying, oh, gee, I think I might just shove everyone else in. That's not an option. You've got to actually go through and identify those employees that are in the community services work in that division of the enterprise, and those that are excluded, and they'll be subject to different treatments. This, of course, will create some issues for those employers where employees might feel that they've got a benefit one way or the other over the others, and there will be some pressures come at different times to the employer. So for small organisations, may include all the staff supporting the delivery, can include the fundraising staff, but where you've got the organisations with a mix of services, you need to identify which staff are providing community services and manage the separation of the treatment for long service leave purposes. And of course, then there's the physical boundaries. Community services schemes are purely state-based. So the Queensland Portable Long Service Leave Scheme for the community services is only applicable to those workers who perform work in Queensland. So it's all persons who provide community services inside Queensland, north of the Tweed, etc. And it does not matter where the employer is based. So an employer that's based has admin and offices in Sydney, but does the work here, where the frontline staff are delivering here, is required to be registered and pay in Queensland. The Queensland organisation that has staff that deliver all their services only in Tweed Heads, for example, those staff, notwithstanding that they're employed by a Queensland entity, are excluded because they're not providing community services in Queensland. So we've got to look and exclude those employees that perform services outside Queensland and those that perform non-community service work. So you need to be very clear about allocating and separating where the staff are on that. Sorry, just trying to get this mouse to help be cooperative. Okay, so there's two other states with community services portable long service leave, Victoria and ACT, and each of those schemes recognise time spent in others. So if one of your staff transfers from Queensland to Victoria, there's a potential that the service in Victoria will count for services in Queensland, and this is relevant for avoiding the loss of credits. But please bear in mind that the definitions of what is regarded as community services, you can't just overlay them and say they're all the same. They are very, very different. All three are very, very different in their terminologies used. They might be describing the same part of the community services, but use distinctly different terms. So you've got to ask, does your organisation fit within that definition? That will be something that each organisation needs to do on their own, in the respect of their own entity, to say, do I fit in these interstate ones? And it's important to understand that if your staff, for some reason, are required to go to those other ones. But if they're going to New South Wales, there is no matching scheme. And so that can take the employee outside the entitlements. Locums and secondees. So if you have an interstate secondee come up here to Queensland and deliver, if it's greater than 5 days work in a quarter, that worker is required to be registered, wages reported, and the levy paid. Even though they might be traditionally living based in, say, in Sydney, the fact that they come up here and work in Queensland for 5 days requires them to be registered. So the work of service, note that the work of service credits lapse after 4 years of inactivity. That is no further credits of time worked for any employers in Queensland. So bearing in mind that, let's look at how this works if you move someone interstate. Here's an example. So an employee A works for 6 years in Queensland, started in January this year. The employer pays the levy for those 6 years. They then transferred to New South Wales for 5 years, and then after that returned to Queensland for 4 years. So they've now reached their 15 years and ready for their long service leave. So the employer pays the long service leave to the employee for their 15 years service, but the credits for the employee A for the first 6 years have lapsed because they were out of the state, didn't have any credits arise for those 4 years, for more than 4 years. So when they come back, they start afresh. So the outcome is that the employer pays long service leave twice, effectively in respect of years 1 to 6, because the employer remains liable for long service leave at all times. The payment of the levy does not take away the employer's liability. It's just a potential clawback that you may get. And so in this case, the employer claims back from QLEVE the credits for the final 4 years of payments, which may or may not match the levy paid. Service credits, they start, the engagement period is the key term. And so it starts on the day that an employee is engaged and it ends on the day they leave. Quite relevant for the next question, which is the credits arising. If a worker performs community services work in a return period, that's the quarter, just ended 31 March, for example, then the worker is credited with 1 day's service. This is out of the explanatory memorandum notes. Each day that occurs in the return period, irrespective of whether the worker performed community services work on a particular day. So the worker doesn't have to actually be at work to get the credits for long service. Just the same as, you know, at the moment, if an employee is on holidays or is away sick or is some days off, those days still count for towards their long service leave 15 years entitlement. So there's a consistency of treatment in that regard. So they don't have to actually perform community services work on each day in order to qualify for a credit. So there's a degree of consistency between the two, what the law is regularly now for payment of long service. So, but they may only happen to do it 1 day a week, and that they get the credit for that 92 days in the return period. And also a part day. So if someone works 1 day a week or works 3 hours a day, that's counted as a day. But then it's adjusted when you come back to this period for how you calculate the pay on a fancy little mechanism. So the levy is payable on the ordinary wages of an employee, of the worker. The ordinary wages are similar in concept to the term that we've all become very used to, which is ordinary time earnings, which is used for the calculation of superannuation. So whilst it uses the term ordinary wages, the concepts are fitting very comfortably close to the ordinary time earnings. So pick up all of the issues around allowances, etc., over award payments will all be included as ordinary time earnings. There's been many cases around that definition from a super guarantee purposes guide, and then how to you need to go through and make sure that you've covered each of those categories of allowances, etc. and excludes things like reimbursements of car mileage that are straight reimbursements. But and of course excludes overtime. For employees, one of the things, of course, with the community services sector is that there are many entities in the sector that have a FBT exemption for their employees, where it allows the organisation to provide up to $30,000 grossed up value of benefits without FBT being incurred. And now that's where they're a health promotion charity, or that they are a public benevolent institution and have been granted the FBT exemption by the Australian Tax Office. That exemption for the FBT, of course, sits with the employer, with the entity, not the employee. The employee might access it, but it is, and whilst the benefit might be capped on a per employee basis, it's not available to the employee per se. It's only available to the employer. So ultimately, when you go to pay the benefits, it has to be done through the employer. It can't be done through the employee claiming off Q leave. So in order to maintain an equitable outcome, where organisations have salary sacrifice arrangements in place under the FBT, etc., the ordinary wages is the grossed up wages. So if you've got an employee who's on 35,000 plus 30,000 of benefits, so the total package is around that 50,000 when it's grossed up, is what comes back to what the figure is. Then that, and beside them is a person who works for a for-profit and they get none of that benefit, but they've got a $50,000 salary. Then both of those, the levy is payable on that 50,000. It's the same. So that's a bit different to the super guarantee. So for the packaging, so you need to be able to be conscious of how you're going to capture that information. The Act is totally silent on how to deal with the self-employed, and we'll come back and talk a bit about that in a little segment on that category. So the levy is, under the Act, is reviewed every 2 years. It's initially set at the 1.35% of ordinary wages, and if you wanted to compare that and do the maths, you're 13 weeks after 15 years, putting aside any of the fancy probability calculations, etc., that the accounting standards get you to do. You know, when you estimate it into the forward, and then you do your probability, and then you do your net present value, and anyway, if you ignore all that, then 13 weeks after 15 years is the 1.6% recurring, so 1.67 roughly. Provisions when in the accounting standards use the probability factor. So if you wanted to do the straight maths on a simplistic basis, the portable long service levy equals roughly 80% of all staff achieving the long service leave entitlement. So that's where, at paying 1.35% instead of paying 1.67%, that's your break-even point, is around that that 80% of staff. So if you want to estimate what the profit and loss impact is to your organisation, then the steps you do is estimate the percentage of your staff that you think will achieve 10 years service, because you're comparing what it was against what it is now. So what it was 10 years pro rata service. So multiply this percentage to the long service leave of the 1.667. Then you take that off the 1.35 and apply that percentage to the ordinary time earnings to estimate the additional expense. So the example, let's say 25% of your staff is all that historically ever achieved long service leave entitlements. So you multiply 25% with the standard 1.667, so 0.4167. So, sorry, that little error has crept in there. So you then take that off the 1.35. I beg your pardon. It's too late the other night when I was writing this. So 0.9, the additional cost is not 0.4167, but the 0.99% of wages. So nearly 1% of wages will be the additional profit and loss expense that the organisation will incur over time. And bear in mind also that it will also be, of course, the cash flow effect that you might put aside from a profit and loss point of view, the expense in years 1 to 9, but you don't pay out any cash until year 10, whereas under the levy, you're paying it out quarterly. So the cash is gone very early in the piece. So a worker can apply to access their long service leave after 7 years. So the first applications will be in January 2028. However, the employer remains liable for long service leave, for both service periods before 1 January 21 and after. So in what circumstances will the employer pay the long service leave to the employee rather than it just being claimed by the employee off Q leave? Well, where all current employees as at 1 January will have service that is prior to the start date of the scheme. So they'll have entitlements that will need to be added to what is ever going to accrue under the scheme. So as a blended payment, that will be from the employer rather than from Q leave. So all employees, wherever any employee is entitled to long service leave due to prior service prior to 1 January 21, where the employee has salary packaging in place, again, if it's a PBI type benefit with exempt benefits, that can only be achieved through the employer. And it can, of course, only be achieved through meeting the various caps that exist within that legislation, the 30,000 cap. Or circumstances where the employer provides a more generous long service leave entitlement than the portable long service leave scheme. There's a number of employers in the community services sector that provide for long service leave to be allowed for after 10 years. So people get their 13 weeks after 10 years service. So that means that the employer will be separately accruing alongside the payment of the levy. Now, if you really want to find yourself intrigued, try working out how to do the payment of long service leave under the Act. Gone are the simple methods. You've got to do these new calculations of how it will be done. So you've got to come together with this concept of the classifications and the moderated wages as a concept. So, and I'll take you through that in a moment, but so the formula is in the two sections. One for the same formula, one for the payment to the individual and one for the reimbursement to the employer. Same methodology. So you need to calculate the amount of the registered workers' moderated wage, note it's registered workers, of course, moderated wages for each return period. So after 7 years, you'll have 28 quarters that you've got to calculate. For each quarter in which they were credited with service. So if you had someone who had a gap of a few years, 2 years away interstate, for example, then that gap, that there's no service, that period is ignored. The then the other terminology is the annual rate of pay that was payable for the classification level at the time that the long service leave entitlement was paid. So note that for the calculation, it's based on what is the pay rate on the day that the payment is being made, not what they've been paid for the corresponding 7 years or whatever. So the classification level is the workers classified under an industrial instrument, and so that might be the award, or for those who under an EBA, it'll be that document, or if it's under an employment agreement for contracts for the CEO, for example, then the industrial instrument will include their employment contract. So you've got to compare the actual wages against this wages paid the rate of pay that was payable for the classification. So they may not always be the same. So here's a worker who's going to claim pro rata for 7 years. We're saying that the annual rate of pay at the time of the claim was 80,000. And we're going to cheat and say they had the same rate of pay all the way through. So there were 4 reportable quarters. So the moderated wages all the way through, it's 25%. So you've got to add together all those moderated, so the 25%. So you can see that that the wages for the year were paid 20,000, so that's your 0.25. Then they won't always work out that way because you'll have different parts of the year with different amounts being paid. So it'll be a percentage that you got to sit down and do the maths at each quarter, or ideally the software will capture somehow. Then you need to add all those together. So we've got 28 reportable ones, and we've got 28 by 0.25. Now that's assuming that we've got all those, but we've got to add them all up for that. And remember, this can go out for 10 plus years. So it means that you've got to keep all those records for much longer. So the calculation in the Act is that S, which was the moderated wages, by the 0.867, the factor, by the rate divided by 52 weeks. So the rate we work out for 80,000 is the 1538. So therefore, for a 7-year pro rata claim, down the maths is down the bottom there where it works out as that. Of course, you can then proof check it by going back, oh, well, I would have said it was 13 weeks after 15 years, where it's 7 years. So we've got 7/8 of 13 weeks by the pay rate, bang, done. No, got to go through this really convoluted methodology in the Act. So the employer can apply for reimbursement to the employer of the long service leave that's been entitlements of the employee. Now, bear in mind, this may or not equal the contributions paid by his levies. So an example, the employee reaches 15 years of service in December this year. So they're now entitled to long service leave because of all their service prior to the commencement of the scheme. The employer pays the employee their entitlements, then they claim back the long service leave entitlement using the above formula, and that may or may not equal the levy paid. What's the accounting treatment for all this? Well, the levy paid is best regarded as that it's an expense. The employers remain liable for long service leave of all employees, so they need to maintain their provision for the long service leave liability, to update for accrued service and pay rate changes consistent with all of the prior years. Probably need to review the probability ratio. Those in the scheme are now more certain. And then to calculate the potential recovery from Q leave. So, bear in mind that, changes in pay rates, if we used an example of say a CFO who was there, worked for the organisation, was paid that $80,000, and then said, righto, I'm going to swap my roles, and now I'm going to be paid $60,000 because I'm going to swap, and the person who was my 2IC is now in charge, the CFO. I'm going to stick around and help out the organisation. So under the formula, it could well be that when the long service leave is paid to that individual for the reimbursement back to the employer, it's based on the 60, because that's the salary and wage at the date of claiming the long service. So the employer certainly needs to be on their toes to recognise what that is, because that the figure that the employer may have to pay that individual may be very different. So going back a step, in the in the financials, in the balance sheet, it will still be a case of recognising the liability and carrying that through. So income tax, the levy is necessarily incurred in carrying on business. It's deductible for the employer. Fortunately, the view is that it's not restricted by the section 2610. And that provision ordinarily restricts the deductions for leave payments until that you don't get to claim that from an income tax point of view until such time as you've actually paid it till the employee's received the wages. So in this one, in a technical sense, the levy is not actually a payment for leave. You might feel like it, but it's actually, in a technical sense, it's not. So therefore, the 2610 does not apply, and there's an ID to this effect. But it is classed as a payment to a worker entitlement fund, and that's what the scheme it falls within. And as a QLEVE administered fund, you can't just go and set one up and start saying I'm going to use one of these animals. The QLEVE administered fund should be appropriately recognised by the tax office and registered to be classed as a valid worker entitlement fund, and the employer would then be exempt from FBT on the payments into that. So the outcome being that the levy will be deductible to the employer and will not need to appear anywhere on the FBT return of the employer. The self-employed, a brave newish world. The ACT's been doing it for the self-employed, but other than that, this is a new world. You know, super doesn't go down this path. It's there, and initially when we were saying, well, how do you calculate the ordinary wages, we were being just referred back to the, well, just what's the wages that are paid? And you go, but hang on, self-employed, they don't pay wages to themselves. There's no such thing. So the ordinary wages is most likely to be calculated based on gross earnings. But there's still the question out on how do you treat things like outlays? How do you treat where the self-employed person also has employees as an expense? Where do you get down to it? Because ultimately the self-employed person will claim those expenses against their running costs, their income, and they will then have a net income from which they'll take drawings, but drawings doesn't necessarily equal any sort of concept of wages, because you may or may not take the drawings because they're subject to cash flow constraints rather than profit and loss constraints. So if you've got anyone that you want to look at doing the self-employed, they'll need to think carefully about it. The income tax treatment, we think probably the best regard is it's likely similar to income protection insurance. where you make a payment with no certainty that you'll ever get the money back. And look, that is the real risk for a self-employed person, that they could make these payments and the level of fees that they're earning changes at the time, and so they then have a lesser figure to get back. Maybe you can get more. It'll be a very interesting exercise. But whilst the Act doesn't have it in it, the EM does have the opt-out reference to allow people to step out. So, commercial risks. What are those commercial risks? There are a number of those that an employer needs to be very much aware of. Firstly, the transfer of an employee to a division that is outside the scope of the scheme. Now, these all work on the basis that once a worker is out of the sector for a period of 4 years, their service credits lapse. So that means that if they move out of the community services sector in Queensland, then they're out of the scope of this scheme, unless you can find a way that they sit in the scope of the schemes in the ACT or Victoria. So the transfer of an employee to a division, so if you've got a business, and let's go back to our aged care, so you've got a home care division and an residential aged care facility, and someone has been purely working in the home care facility, and then you transfer them and they stay permanently in the aged care capacity, then there is the potential there that after a period of 4 years, the levy that was paid on that period of time that they were in the home care facility work will lapse, and the employer remains liable, so the employer has to pay effectively long service leave twice on that. Similarly, if you transfer an employee interstate where it's outside the scope of the scheme, so you transfer an employee from the Brisbane, or the maybe you can't, COVID, but anyway, but you transfer someone from the Brisbane office down to, say, Grafton, and they're down there for more than the 4 years, then their service credits again lapse, and that means that the employee will no longer have credits, but because they're still employed by the employer, the employer retains that liability. Now, there was a suggestion by QLEVE that what you would do is to ensure that those individuals return to the Queensland, to work within the Queensland scheme. So the person who's down in Grafton comes back up and works up here for a period of more than 5 days, and so that they are then back in the system, and therefore reset the 4-year clock. So and technically that would work. If the person who got transferred to Grafton came back to Brisbane or the coast, Gold Coast, and worked for a period enough to create a credit on the return, on the levy, on the return, quarterly return form, then that will put them back into to restart that 4 years question. Similarly, where you bring people from interstate, where they come up here, perform a function here while someone's on leave or for a particular project that's running to help you meet capacity, and then they return to a state that's outside scope, then that would end up with having to pay the levy on those wages, and you just got to think of it. Well, that's just a cost of doing business. We're not actually going to get that back. And then there will be the question that will arise on the ability of an employer to whether they can deny transfers of staff that would result in the employer losing the credits. You know, for example, an employee is working inside the community service sector scope in Queensland and sees an opportunity within the employer to move to be promoted to a different role, applies to move to that role, but that role is in a division that it sits outside the scope of the scheme, and it'll be a question then for the industrial relations lawyers: to what extent can the employer say no, because you're going to cost us money when we lose all the credits? You imagine if you had someone there that that had 6 years service and was then transferred, and the employer loses that credit, but still retains the liability to pay the employee. And that, from an employer's accounting point of view, if we go back to our slide on the accounting, the moment that you did that, it would have a P&L impact at that time, because when you do the test at each period of time about each set of financials, what am I able to claim back? You'd say, well, at the moment, year 1, we're still able to claim it back. Year 2, we're okay. Year 3, and then bingo, year 4, we're out. We've lost the credits, and the staff is working in a different role. So it certainly has those questions. Now, just turning to some of the questions that flowed through the, and I thank you all for those who submitted the questions earlier, so that hopefully we've covered off how we deal with support staff. The 1.35%, yes, it is payable each quarter, and it is required to be paid in cash. It is subject to review. That percentage could change in 2 years' time. There was a question that is yet to be fully resolved of what happens if an employee is currently covered by the building and construction scheme and is working within the community services sector. That question's still on notice, so we're still waiting for a response on that. So there's a couple of other questions that are there in terms of I think we've covered off on how you claim it back, and the fact that you've got to test whether the employees, which ones are part of community services, including that support. Is maternity leave included in the service period? Good question. I might have to take that one on notice. I think it would be classed as ordinary earnings, so we'll take that on notice and come back to that one. And then there's another question there about, does the employer pay super on that? Again, and it's the same with payroll tax. For those organisations that are liable to payroll tax, if the employer pays it, it comes into its ordinary. It comes through as the ordinary work of the employer, and it has to be tested as to whether it's there's a liability. So for super, are you required? Does it fall within ordinary time earnings, or is it termination payment? But that question needs to be done for each. And so if the employer makes the payment, yes, it's subject to all the rules that are standard for the law now on super. If QLEVE pay it, it's a relationship purely between QLEVE and the individual, the worker. It's not a relationship between the employer and the worker. And payroll tax is the same. So if the employer pays it, they've got to pay payroll tax. If the QLEVE pay it, there's no payroll tax. Which way do you want to go? And are philanthropic entities that support community services organisations included? In order to be in there, let's go back to the basics. First, you've got to be providing community services, and you've got to actually first on be an entity that is providing those community services, and then if you are providing community services, then some of the people inside the organisation who are supporting that provision get brought into the portable long service leave equation. So first off, you've got to have an employer with employees providing community services. So for an entity that all it does is to support others who deliver community services, it's not actually delivering community services, it's supporting others. So it's, whilst it is focused on there, it's not actually delivering the service. First off, you've got to be delivering. So so I think that we're now coming up to that. So bear in mind, as in conclusion, that it's for profits, not for profits, size is of no consequence, other than adding the complexities, and that there are a number of aspects around this that will have some significant impacts on the organisations. So you need to be able to understand it clearly and measure it. And I dare say we'll have a follow-up seminar soon on a few tips and tricks that are looming and questions, and hopefully have that answer on the where you've got people sitting across multiple portable schemes. Thank you very much for joining us today, and trust that we've been able to help you clarify some of the questions around the new Queensland Community Services Sector Portable Long Service Leave. Thank you.